How's everybody doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today's episode, I just wanted to provide a quick update on New York Community Bank, Republic First Bank, and basically the failure there, and then also a bank called Blue Foundry Bank, which is kind of a little bit of an interesting situation with another activist investor kind of popping up. So a little bit, of interesting drama and intrigue beginning to bubble up there. So, but I wanted to show, this is going to be a shorter episode today, but I had enough information here with these couple of banks that I did want to provide everybody an update. So let's start with New York Community Bancorp, and let's see what's going on there. So a lot of news with New York Community this week. So first thing up, on April 29th, they basically came out and said that they were going to postpone their shareholder meeting. The bank had earlier announced the shareholder meeting has been pushed back to June 5th. They had earlier announced that it would be held on May 17th. Additionally, the bank's board approved employment-induced awards to 3 recently named executives at the company. And let's see here. The employment inducement awards are being made outside of the bank's 2020 Omnibus Incentive Plan and the company's shareholder-approved equity compensation plan, but will generally be subject to the same terms and conditions as apply to awards granted under the plan, according to the press release. So there. But then they had released this, and this is the article that we're looking at right here now, called New York Community Expects Elevated Reserves, Charge-Offs, and CRE deep dive. So New York Community Banks expects elevated loan loss provisions and charge-offs through the rest of 2024 following a deep dive review of its commercial real estate portfolio. The company conducted a deep dive analysis of credit quality in its CRE book, including 75% of its $3.1 billion in office loans, 36% of its $36.9 billion in multifamily loans, and 24% of its $7.4 billion in non-office CRE loans during the first quarter. Following that, the company updated its total allowance for credit losses to $1.29 billion, or 1.56% of its loan book, from $1.05 billion, or 1.23% of its loan book at December 31st. 2023, and that included a 1.3% allowance for multifamily losses, a 10.3% allowance for office losses, and a 1.52% allowance for non-office commercial real estate losses. While the company took a smaller provision for credit losses in the quarter of $315 million compared to $552 million in the linked quarter, it guided for high provisions throughout the remainder of 2024. We do expect to see an elevated level of provisions through the rest of the year as market conditions potentially impact more borrowers. Gifford said, until the rate curve comes down, there will be additional stress. The company forecasts a total provision of $750 million to $800 million in 2024. So, yeah, obviously, with the 10.3% allowance for office losses, they're expecting to get a significant hit on their office properties, and so they're beefing up their loan loss reserves in anticipation of this bigger hit coming. Again, they did a deep dive to try to get this company is still trying to get their arms around this commercial real estate portfolio, everything they inherited from Signature Bank when they took that on, and just what's going on there. So they've got a lot of commercial office space in New York City and North Jersey, and that's going to continue to weigh on the bank as we go forward. Some of the other things here is that New York Community sketches path to modest credit losses and pure profitability. So New York Community Bank set out a multi-year array of financial targets that included a reversion to relatively low credit expenses in 2025 and profitability levels near industry norms by 2026. Such a turnaround would represent a dramatic recovery for a bank that has been shaken by CRE losses and the strains of becoming a larger institution subject to tougher regulation. New York Community Bank stock has lost about 2/3 of its value since January, despite a rebound May 1st when the plan was unveiled. The bank hopes its transformation will narrow significantly the valuation gaps to larger peer banks, said their CEO. We've done this before and we feel we can do it again. Yes, that would be quite a magical turnaround I think that a 2-year period of time in the next 2 years, the thought that everything is just going to magically turn around. Commercial real estate is not that quick. You can't. It's like steering a ship. It's like steering a big cruise ship. You can't just turn it on a dime. You can't move it that fast. And a lot of this stuff, it takes years to bubble up, and then it takes years to work out, and you get mired in bankruptcies and litigations, and just people handing keys back and all this kind of stuff. I mean, there's just so much that can happen there. I mean, I think 2 years is amazingly optimistic. So, and then finally, there was another article that basically says New York community sees little impact from deposit team departures. So New York Community Bank has so far seen minimal impact on its deposit base, even as a slew of private banking teams left the company in April. The company had 100 private banking teams left following the departure of 26 teams, and is working hard to keep those remaining teams. The bank is bullish on its ability to keep most of the deposits under those teams intact. Executives said on the company's first quarter earnings presentation, deposits under the teams that left total about $6.2 billion, of which just $200 million so far have left the bank. Most of those outflows occurred in the first 2 weeks since the departures and have since slowed to a trickle. We do recognize some of those deposits will take time to migrate out of the organization. Joseph Otting, the CEO, said, so there's always that risk for some more deposits, but we've actually had pretty good growth in deposits during the quarter, and we continue to see that carrying through into April as well. The key thing there is we do recognize some of those deposits will take time to migrate out of the organization. In other words, yes, when these bankers leave the bank, you're not going to see a major turnover in a couple of weeks or 1 month. I mean, they're going to basically continue to bleed deposits over the next year or two as these employees that left get settled at their new banks and begin to move relationships over. So he recognizes that. He knows that. I mean, this gentleman's been around a long time in the banking business. He knows how these things play out. But I don't know, to kind of sit there and say like, oh yeah, well, it's fine, all these people left, they could potentially take billions of dollars in deposits with them, and it's cool because we haven't really seen any impact in the first 2 weeks. Well, yeah, it takes longer than 2 weeks for that to start playing out. I mean, but that will play out, and that will continue to hamper the bank. So a lot of news there with New York Community Bank. That bank is not out of the woods by any stretch of the imagination. Obviously, they got a new management team. They shrunk the size of their board a little bit. They pushed back their annual shareholder meeting a couple weeks. So they got a bunch of new board members, the new executive team in place, but they're bleeding employees. They're going to be bleeding assets and liabilities here. They still trying to get their hands around the whole commercial real estate situation. I'm sure they have bond issues with unrealized losses in their bond portfolio. So still dealing with a lot. They did get $1 billion capital infusion, which basically helped to save the bank. Now they're trying to just stabilize things and see if they can get things moving forward. But I think that obviously, that's a pretty rosy picture there. I think that they're putting forward. So, okay. So let's get into this. Let's go to Republic Bank for a second here. A lot of kind of Republic Bank news. So Republic Bank failed last week. It got bought by Fulton Bancorp. Fulton Bancorp, basically, they feel like they came out with an article on Monday, basically touting their earnings boost, the growth in the Philly market. And, so they're really happy here. Then so we had a number of articles here. Basically, Republic Bank seized, but the Fulton CEO says the deal accelerates their Philadelphia growth strategy by 5 to 10 years. The combined bank will have 80 branches and almost $7.9 billion in deposits and 3.8% market share in the Philadelphia market, leaping past Santander Bank and Univest Bank and Truist Bank to rank 7th in market share. The Fulton will move from $27 billion in assets to about $31 billion via adding deposits and certain loan relationships. Republic also had 2 branches in Manhattan, where Fulton had never had locations. They're not sure if they're going to keep those. And then Republic had 434 employees at the end of 2023. As with any normal merger or acquisition, there will be some duplicative back office and executive roles. And just like with the branches, the Fulton CEO said no specific decisions have been made on job cuts. but has guaranteed all Republic employees that they will be paid for the next 90 days, and its customers will experience no disruption in service. So Fulton's teams completed what would normally take 3 months in a typical transaction in 2 days by working with the FDIC on the Republic deal. So that was the one article. Then another article basically came out and said, after acquiring failed Republic, Fulton Bank expects 40% cost saves from branch and job cuts. So in other words, they're going to, so well, let me read this first. So while looking forward to estimated cost synergies of 40% from cutting duplicative jobs, branches, and vendor contracts after absorbing the parent company Republic Bank, here are some key takeaways from the discussion. Basically, the transaction, again, adds to deposits and loans. It improves liquidity and capital position through the balance sheet restructuring and a $250 million equity offering announced Monday morning before the call. They maintain strong management culture, a robust balance sheet, lower execution risk due to familiarity with Republic's market and customer base, as well as an FDIC asset discount of $347 million. So 40% savings and synergies. For anybody not familiar with like M&A deals or whatever, that's a huge cost savings, and that tells you right there that they're going to be cutting. Republic Bank had roughly 434 employees. I would say probably 2/3 of those employees are going to be gone. Maybe not that many, maybe 50%, but definitely 50% of those employees are going to be gone. They're obviously going to shed a few branches and things like that. But that's a significant amount of cost savings. That means that they're going to be cutting jobs in the months ahead. And like I said, and then there was another article, how everybody lost, like how the war for control of Republic First became such a debacle. When Republic First Bancorp failed last week, the activist investors that played prominent roles in its turbulent saga were left with tens of millions of dollars in losses. Greg Braca, the former TD Bank U.S. CEO, said his investment group lost as much as $35 million, not including hefty legal expenses from its long battle with Republic First leadership. When regulators seized the Philadelphia bank on Friday, Braca's team with South Jersey power broker George Norcross and Parker McKay CEO Philip Norcross to acquire just under 10% of Republic First shares in February of 2022 when the stock was trading about $5 per share. The Norcross Broker Group was left holding the bag when the FDIC seized the bank after the stock price had bottomed out at 1 cent. Abbott Cooper of New York-based hedge fund Driver Management Company became the bank's first activist investor, and his firm bought shares of Republic First at about $3 a share in the fall of 2021 because Cooper believed then that Chairman and CEO Vernon Hill was implementing a fast growth strategy that was not maximizing returns for the shareholders. So Cooper said he decided to sell the stock because the Federal Reserve was raising interest rates and he felt he had accomplished what he'd set out to do, remove Hill and add an ally, Peter Buffalo, to the board. And he said, but we couldn't do anything else. So, a lot of fallout there from the Republic First failure. Obviously, these investor groups lost everything. A lot of the shareholders pretty much lost everything. If you own that bank stock, pretty much worth nothing. Which is just a travesty for shareholders in that thing, because like you said in this article here, like it didn't have to be that way. And then finally we get to this article here. So Republic First broken balance sheet kept buyers at bay until it failed. So Republic First Bancorp's deteriorating financial performance made a sale on its own, even in a distressed deal, unlikely. But purchasing the institution from the FDIC offered the buyer cover. The demise of Republic First Bank was preceded by years of financial performance struggles, including a large underwater bond book that weakened its balance sheet strength and net interest margin, and a branch-heavy footprint with a high cost of deposits that weighed on capital. But certain aspects of the FDIC's terms made a deal doable for Fulton Bancorp. Republic First had emulated the old commerce model through a higher cost branch infrastructure and aggressive expansion, which put pressure on capital. Piper Sandler analyst Frank Schiraldi wrote in an April 29th note. Ultimately, the largely fixed rate asset book, coupled with Fed rate increases, the higher growth, as well as marks to its large relatively securities book, left Republic First in a precarious operating position and led to the FDIC takeover. So they're basically saying here that all their troubles in the underwater bond portfolio, the attempts to raise capital, like all this stuff wouldn't have allowed, somebody to come in and buy the bank, or even if they would have, tried to sell it at a reduced cost or whatever. Yeah, I mean, there certainly is some truth to that. Am I totally buying that? No. I would go back and look at what I had wrote, or not what I wrote, what I had said in the previous episode that I had on Republic First Bancorp. But so I think ultimately it looks like this deal is probably going to work out pretty good for Fulton Bank, but it's terrible for those investor groups and for the existing shareholders and for a lot of the employees of Republic First Bank, who unfortunately are probably going to be looking for another job here in the coming months, and that's just terrible for them. And certainly wish them the best and hope that everything goes okay for them. Had a lot of friends that worked at that bank, so definitely hoping for the best for a lot of them. But okay, Len, let's finish with this last story here. So this was kind of an interesting one. So an activist investor pushes Blue Foundry to sell as 3-year conversion mark near. So basically, when you have a mutual bank and when they convert from a mutual to a stock holding corporation, and basically as a commercial bank, there is a 3-year kind of conversion process there, and it plays out in a number of kind of sectors. But then once the bank becomes fully converted and now has stock and shareholders, that's what they are coming upon now. And so this activist investor who was involved in this is now pushing the bank. He wants the bank to basically hire an investment banking firm and look to either sell the bank or merge together, or maybe do a merger of equals or something for this. So let's just go into this for a second. So activist investor Lawrence Seidman and the Blue Foundry Bancorp continue to butt heads as the shareholder pushes the bank to sell. So Blue Foundry attempted to have Seidman's proposal calling for the bank to hire an investment bank to facilitate a sale excluded from its May 16th shareholder meeting. The company's legal counsel argued to the Securities and Exchange Commission that the proposed exceeded the 500-word limitation. However, the SEC ruled April 1st that the proposal falls within that threshold and could not be excluded from the company's annual meeting on those grounds. In Seidman's proposal, introduced in November 2023, the investor urged the Rutherford, New Jersey-based bank to engage an investment firm to sell the institution or merge it with another bank in a deal that will maximize shareholder value. Recently converted stock holding companies are prohibited from selling until 3 years after their conversion. Seidman's push comes ahead of the 3-year anniversary date of Blue Foundry's conversion to a stock holding company from a mutual in July of 2021. The greatest long-term value for Blue Foundry stockholders will be realized through the prompt sale or merger of the company, Seidman wrote in the proposal. With the annual meeting approaching, the company urged shareholders to vote down the proposal in its most recent proxy filed in April. According to the filing, the company in June 2023 retained an investment bank for advice on maximizing value, including the prospect of a sale. When asked if the engagement was still ongoing and what advice the advisor offered, Blue Foundry declined to comment beyond the proxy statement. The board is open-minded to a merger as a means of maximizing shareholder value, but the proponents' antics and this proposal have the effect of placing a for sale sign on the company's door, which we do not believe is the best way to maximize shareholder value, even if a merger transaction is pursued by the board. So basically a lot of perhaps some more intrigue there, but that caught my eye because, again, you're as with Republic Bank and as with several other banks around the country, you're seeing this pattern of these activist shareholders kind of coming in and really stirring things up, pushing for replacement of board members, trying to get their people put on the board, buying up stock in the company, trying to get control. Trying to force executives out, trying to force the banks to sell, and I think sometimes that is warranted if you have a board that's doing certain things or not doing certain things or not trying to maximize shareholder value. Perhaps it's an older board and maybe it's just time to get some new blood in there, or it's time to sell the bank, whatever the case may be, and they just don't want to do it. They just and so you saw a lot of this stuff play out with Republic Bank. Now this is kind of a unique situation because this is a transfer from a mutual to a stockholding corporation or a commercial bank, if you will. which happens, not, pretty regularly. I mean, every year you seem to have a couple of mutuals transform into commercial banks. There's definitely not as many mutuals left in the banking industry as there was a few decades ago. But I think what's interesting here is that, like, they just are finishing this 3-year transfer, and this guy is like already jumping at the bit, like, yeah, let's sell. So to quote Jim Cramer, sell. So it's so like I said, so it was just like an interesting thing to note. I'm going to keep my eye on this one because I wouldn't be surprised if this continues to get a little nasty and we have a little we have a little bit of drama here back and forth on this one. So obviously, I will keep an eye on all of these transactions. I'll keep an eye, throughout the rest of the year on kind of how Fulton does with the absorption and what ends up happening with the Republic First, acquisition, as you will, and their employees. Continue to keep an eye on New York Community Bancorp, because they're obviously large enough regional bank that if they fail, that could cause larger problems out there. So, but like I said, if everybody likes this episode, please make sure to like, share, and subscribe. That always helps the channel, and I will be back again real soon. Thanks.